Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999.
Hello, you're listening to Friends with Money. I'm Michelle Baltazar, Editor-in-Chief at Money Magazine. Thank you for joining us. Our guest today is Juliana Rajkovic, Partner and Investment Advisor at Escala Partners. Prior to joining Escala, Juliana has also worked at an investment bank and a leading stockbroker before finding her new home at this leading financial advisory firm. A bit of background on Escala Partners. To provide context on our chat, Escala offers financial advice and investment management services to ultra-high net worth individuals, families and family offices, and charitable foundations. Their client portfolios range from $5 million to $150 million in assets. In short, high stakes all around. So I appreciate Juliana hopping onto our podcast today to provide her insights on what to make of the extraordinary time we find ourselves today. Juliana, thank you for joining us.
Thanks so much for having me, Michelle. I'm really excited to be here.
Now, excited also a little bit for me personally. I'm a little bit panicky. I just feel like the world has turned upside down in the last week. So tell us, how have you been? Have you been working over the weekend? Working 24 hours? What has it been like?
Oh, it's a really fascinating time in the markets, isn't it? And it's absolutely, I think, quite a historic time as well. And I think conversations like this are really important for hopefully helping people cut through some of the noise. So market uncertainty and volatility is certainly up following the recent tariff announcements that we had on the US Liberation Day. And we've seen some huge moves across all equity markets, not just the US. Even though we've seen this before, these are the times where our clients really do count on us. So a lot of time's been spent talking to the team, but obviously reaching out to our clients as well.
Well, some people are describing the US President, Donald Trump, as a shock agent. So, for example, on the 5th of April, investment bank JP Morgan predicted a 60% chance of the global economy entering a recession by the year end. So that's up from 40% previously. Let's start with that. Surely it's not every day that recession forecasts move so dramatically. Is it a case of reassessing your portfolio and making decisions in the next month, in the next 3 months? A little bit now and a little more later? How does that look like in practical terms?
It's really important to stress test your portfolio on an ongoing basis and do it periodically. So not just in times of market stress, even in times where we have strong market gains like last year, where equity markets were up 29%. So rebalancing should be done when required and should be done substantially if and when your goals change. But I'd also let investors know to not be too reactive to markets as well. There is a fine line.
So you talked about rebalancing, and I'm trying to think about if you have a financial advisor, that would happen automatically, for example. But what if you don't have a financial advisor? You have let's say, a portfolio that's maybe $1 million or less. How do you rebalance or stress test?
You can still develop some of those healthy habits and really sit down on a periodic basis with yourself, whether that be quarterly, whether it be semi-annually, and really sit down and look at your portfolio in terms of how it's performed versus your expectations, your long-term investment objectives. What's the volatility like in that portfolio? Is it something that you're going to be comfortable with? If the portfolio does decrease by 10% or 20%, if we do enter a recession, like you mentioned, how much volatility can you withstand? How much illiquidity can you withstand? So they're the sorts of questions that we would encourage all investors to ask themselves on a periodic basis.
So I'm now imagining our listeners listening to us right now, and there'll be two types of investors. Those who are prepared for this unlikely scenario, so they've stress tested, they're well diversified, and perhaps they're ready to kind of adjust their portfolio after what's happened. And no one could have predicted that there would be this sweeping tariff cuts and what it means for the markets. Then we have another group of investors who are like probably listening to us right now and going, okay, Michelle, fine. I should have done that a year ago or 2 years ago. But now I'm sitting at a portfolio that is overweight in US equities, or I've got international ETFs, and I'm down 10% or 15%. I've learned my lesson now. Where do we go from here?
It's a really good question. So the first thing that I would be saying, if you are overweight US equities, you've probably done quite well over the last couple of years. Remember, you've probably done you should have been doing close to 30% in 2024, about 24-25% over the last 2 years as an annualized figure. So that's a really good result. I'd now like to remind investors that those time-tested principles do work, and those are diversification, remaining disciplined, and really maintaining a long-term view. So there's a real balance between staying calm, being consistent, and not letting your emotions drive the decisions, which is really important when it feels like there's a lot of uncertainty in the world, when there are media headlines that like to do a lot of fear-mongering. This is a period of repricing and it's potentially a regime shift. However, it's not the end of the world.
Let's move on to talking about defensive assets. So now that we've got recession forecasts going up, how can an investor introduce more defensiveness into their portfolio?
So we've always had a belief that asset allocation is key, and our investment strategies for our clients are very much based on their long-term goals and objectives. And our clients typically have very diversified portfolios. So they are invested in cash, fixed income, equities, alternatives such as private equity, private debt, venture capital, and even gold. So gold typically is something that has been in the headlines recently. And for those who aren't familiar with gold as an investment, it typically acts as a hedge in uncertain markets, both against inflation and geopolitical risk. And with gold, it's not necessarily about timing gold, but about having a select strategic allocation in your portfolio to cushion against market volatility, such as what we're seeing now.
So now we've talked about global equities, we've talked about gold. We haven't talked about fixed income. So what is the state of play right now for those who hold government bonds, perhaps corporate bonds, and other types of fixed income products?
Fixed income is an interesting one because 6 or 7 years ago, when rates were pretty much at zero, it didn't really have much of a role to play in portfolios. And if anything, it was dragging on returns. We didn't get much from cash or term deposits. And even our fixed income funds were offering 4 to 5% if we were lucky. Obviously, since rates increased a couple of years ago, fixed income as an asset class has now become attractive all of a sudden, and it's back in play. Many of our fixed income funds that we look at, for instance, last year returned in the high single digits, so between 7.5% to 9%, which is a seriously fantastic return if we compare it to what equities have done historically. The ASX 200, for instance, has done about 8.5% historically over the last 40 years. So to be getting a similar return from fixed income is very, very attractive from a risk return perspective. Fixed income provides stability in a client's portfolio, and in volatile times like this, when we're seeing markets down, 10, 15% in a matter of days, fixed income provides that stability, but it also provides clients with that liquidity as well if they do need it.
Now, in the broader theme of alternatives, let's talk about private debt and private credit strategies. How will they perform in this new world?
Private debt is also a relatively new asset class that's gained in popularity, of course, over the last couple of decades. And there is strong appeal while we're still in very much a low yield, high volatile environment. Private debt can buffer some of that volatility in a client's portfolio while also assisting with their income requirements due to the high yields offered through private debt funds. It offers diversification, offers income, and it's very lowly correlated with public markets as well. The one thing that I would stress to investors is that liquidity and access are key considerations, and certainly diversification and the manager that you're using to access these private debt instruments is key. You want a manager that is experienced and also a manager that is highly diversified when it comes to the underlying loans in their portfolios.
Now, I'm very aware that we've probably done a tour around all the asset classes. And if you're still listening up to this point, congratulations, you. We probably covered about 4 or 5 different asset classes there. So let's bring it home. Firstly, let's talk about Australian equities. How should they be adjusted or reassessed after Trump's massive tariff plan announcement?
Of course. So Australian equities over the last couple of years have actually lagged global equities, and we've had quite an overweight to global equities up until now. And that's certainly been the right move given the outperformance of global equities versus domestic. But we are seeing that now change. And certainly with the recent announcements, the tariffs to Australia were almost on the friendlier side versus some of the other countries that were hit. So that could certainly be a positive for Australian equities. But that, of course, will change if we do see a global recession and the situation developing further as well. So it's still a little bit too early to tell. But one of the things I would also encourage investors to have a look at is their Australian equity allocation overall. How much do they have invested in Australian equities? And is there a home bias there? Because ultimately, Australia still is only 3% of the global market, and there are other places to invest: Japan, Europe, and so on.
And that proportion of the world markets hasn't changed in the last 3 decades or so.
Correct.
It's been static between 3 and 5%. Now, my favorite topic, let's talk about property. Now, this is a massive part of any typical portfolio. The research out there is that a typical Australian family will own their own home and have 1 or 2 investment properties. Should we start piling our money on property now with this big scare in the US?
Property is always a tricky one, and Aussies do have their love affair with property, that's for sure. I wouldn't be making any strong decisions or major decisions based on what we've seen over the last couple of days, because that's what it's been. It's been over the last couple of days. I think ultimately it's about reviewing what's right for you and your long-term objectives and goals. And if owning a lifestyle property or another investment property is something that's part of that, then sure, absolutely. I would also highlight some of the regulatory changes that we've seen in some of the states in Australia, which in fact have made it far more onerous to own an investment property than ever before. It's onerous as a landlord. It's onerous even if it's a lifestyle property as well. So I think that's just something investors really need to weigh up when looking at property as an investment, how much time it's going to take, and certainly the underlying costs and the net return that they're going to get from that property. After all the taxes have been paid, after all the fees have been paid, after all the maintenance costs have been paid, do you think that you'll be getting a better return on that property versus cash, versus equities longer term? And then if you think you do, absolutely, go for it. But I do think that should be part of the conversation as well, Michelle.
Well said. I don't think you're impressed about property, Juliana. You've just mentioned all the fees and also the heartache. But I second your views there about regulation. So many changes happening, even some general sweeping comments about don't invest in Victoria because of the new rules there for holiday homes, for example. So now, finally, on a personal note, a couple of my friends are going on a holiday and they ask me, Michelle, what do I do with my money? It doesn't feel like I'm going to have as enjoyable as a holiday like when the Australian dollar was stronger 2 months ago. So what is your takeaway message here? How will the Australian currency perform versus the US currency? And why is the US currency strong at the moment despite the markets going down?
Currency is always a tricky one to pick. And certainly over the last couple of years, it hasn't really been fun to travel overseas, has it? With the dollar where it's been. So I'd say firstly, choose where you're going to holiday based on the currency, and you might have a better time. But on a more serious note, currency is cyclical, and we would deter clients from making any major decisions solely based on currency and short-term movements. The Aussie dollar typically has a long-term average of about 70 cents. And I would be remiss if I was to make a call on where the Aussie dollar ends up by the end of the week, let alone by the end of the year. But I do think it should stabilise, and it will ultimately stabilise. I think, if anything, we should use this currency weakness that we've seen as a real reminder that you do need to diversify globally, and not just by geography, but by asset class and your underlying currency exposures. And I think that might be a nice way of, also talking about what we should be leaving with investors with. And I think it's really about staying calm, being consistent, and not letting your emotions drive these decisions, because this is a period of repricing and it is potentially a regime shift, but it's not the end of the world. So for people that have got longer term time horizons, remember the power of compounding. It needs time. Don't try to interrupt this by timing the market or panic selling. It's about time in the market, not timing the market, which we've all heard before. And sometimes what can actually happen is really significant outcomes, both positive and negative, often come from rare events. And in markets, quite often, some of the biggest down days are followed by the biggest up days. So keep that in mind when making some of those decisions, and don't base your strategy on today's headlines. Base it on what you're looking for longer term. Base it on your objectives, your tolerance to some of the risk, and what you're ultimately trying to achieve.
Well said. Juliana, we've covered a lot of ground there, and I like what you've said about staying calm, staying true to your long-term objectives. So to recap, US equities are down, but don't forget, we've made some money out of them in the last 2-3 years. Local equities, definitely have your local equities exposure or your investments in Aussie stocks, but they are only 3% of the global market. Now we move on to a property. It sounds like it's more of a lifestyle choice once you've weighed in all the fees and everything else that you have to consider when investing in property. And then finally, alternatives as a powerful tool to diversify. Juliana, we appreciate you coming to the episode today. Thanks for your time.
Thanks for having me, Michelle.
Until next, I'm Michelle Baltazar. Bye for now.
Thanks for listening to the Friends with Money podcast. For credible, independent, and easy to understand financial commentary, visit moneymag.com.au. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.